This training is about how you actually get paid: initial commissions, renewal commissions, target premium, residuals, overrides, and chargebacks. By the end, you'll know exactly what every dollar on your statement represents and where the next dollar is coming from. Most agents run blind. They write business, cash deposits, pay bills, and never sit down with the underlying math. That's how you end up surprised by a low statement, blindsided by a chargeback, or stuck negotiating with an FMO without knowing what you're worth. The producers who build real wealth understand their compensation cold. Here's why this matters. The line between a salesperson and a producer is whether they understand how they're paid. A salesperson chases the next deal because they need this month's check. A producer plans because they know what's coming next month, next quarter, and next year. They know which lines pay flat, which pay percentage, and which pay residual income for years. That knowledge changes how you spend your time, how you cross-sell, and how you build a book. Two fears block agents from getting clear on this. The first is the quiet feeling that you don't really understand what you're getting paid. A deposit hits, you assume it's right, you move on. You don't ask, because asking feels like admitting you don't know what you're doing. That fear is expensive. The second fear is chargebacks. You write a Medicare Advantage app in October, collect the first month's commission, and in March the client disenrolls. The carrier reaches into your future commission and pulls money back. If you didn't see it coming, you scramble. If you understand the rules, you plan around them. Both fears dissolve the same way. Learn the structure once. After that, statements stop being mysterious. Chargebacks stop being surprises, and you start making plans based on real numbers. 4 ways agents get paid: Medicare flat rate commissions, life insurance target premium, ancillary percentage commissions, and renewal or residual income stacked on top. Most producers earn from all 4. Start with Medicare. CMS sets a fair market value cap on broker compensation every year, and carriers cannot pay above it. For contract year 2026, the national initial commission for a Medicare Advantage enrollment is $694 per member per year. The renewal, paid every year the client stays in a like plan type, is $347. That renewal pays for up to 5 years after the initial enrollment, under the standard 6-year compensation cycle. A few states pay higher. Connecticut, Pennsylvania, and DC run $781 initial and $391 renewal. California and New Jersey run $864 and $432. Puerto Rico and the U.S. Virgin Islands run lower. Standalone Part D drug plans pay $114 initial and $57 renewal nationally. These are CMS maximums. Carriers can pay less. They cannot pay more. Here's the practical math. Write 20 Medicare Advantage clients this year and keep them on the books, and year 1 earns roughly $14,000 in initial commissions. Year 2 through year 6. Those same 20 pay about $7,000 a year in renewals. The renewal stack is what builds the book. Every year you write 20 more, the floor under you rises. Now life insurance, which works differently. Life carriers pay you a percentage of target premium in year 1 and a smaller percentage of premium in years 2 through 10 or beyond. Target premium is the carrier's calculation of what the policy is designed to take. It's not the same as what the client actually pays in. For a typical fully underwritten term or universal life policy, year 1 commission runs 60 to 120% of target premium, depending on carrier and contract level. Year 2 and beyond drops to 2 to 10% of premium, which is your renewal stream. Final expense and simplified issue products generally pay lower first year, vest faster, and charge back less often. The math looks different from Medicare. A single life policy with $5,000 of target premium at 100% contract pays $5,000 in year 1. That's one client. To match that on Medicare, you'd write 7 Advantage clients. This is why life insurance is the highest revenue per client product in your bag, and why every Medicare client deserves a life conversation. Ancillary lines run on percentage too, but smaller. Hospital indemnity, dental, vision, cancer, and accident plans typically pay 15 to 25% of premium year 1. With renewals at 5 to 10%, premiums are smaller, so absolute dollars per client are smaller, but the close rate is high and chargebacks are rare. Ancillary is the smoothest part of your income. It just keeps coming. Now we get into the part of compensation that separates a job from a business: renewals, and residuals. This is where you stop trading time for one-time checks and start building income that shows up whether you sold yesterday or not. Renewals are the wealth lever in this business. The first time you write a Medicare client, the carrier pays you about $694. The second year, with that same client doing nothing, you get paid again, and again, and again, up to 5 renewal years on the standard 6-year cycle. If you write 100 Medicare Advantage clients in a year and your retention is solid, by year 5 you have a renewal book paying you somewhere around $35,000 a year before you write a single new client that year. Now stack life renewals on top. Every universal life policy you wrote 3 years ago is still paying you a small percentage every time the client makes a premium payment. Stack ancillary renewals on top of that. The producers who own real books in this business are sitting on top of 3 layers of renewal income running at the same time. That's the math that buys vacations, funds retirement, and lets you take a slow week without panicking about cash flow. Now the part nobody likes to talk about, chargebacks. A chargeback is when a carrier takes back commission they already paid you because the policy didn't stay on the books long enough to earn it. In Medicare, the rule is straightforward. CMS requires full chargeback if a member disenrolls or moves to a different plan within the first 3 months of enrollment, often called rapid disenrollment. After that, partial chargebacks happen if the member leaves before the end of the calendar year. After the first calendar year, most chargeback risk drops off and renewals begin to flow. In life insurance, chargebacks are larger and longer. Most carriers run an advanced commission system paying you 9 to 12 months of commission up front when the policy issues. If the client lapses inside the first policy year, they reclaim the unearned portion. Some carriers extend that chargeback window to 2 years. 3 habits make chargebacks rare. First, qualify carefully on the front end. The client who isn't ready to stay shouldn't be the one you write. Second, keep contact through the first 90 days on every Medicare app and the first 12 months on every life policy. A welcome call, a 30-day check-in, and a 60-day check-in catch most issues before they become disenrollments. Third, never write a plan you wouldn't pick yourself. If the plan is a poor fit, the client figures it out and you take the hit. Now overrides. When you contract through an FMO, the carrier pays a commission package to the FMO, and the FMO passes through the agent rate to you. The difference between what the carrier pays and what you take home is the override. That override funds your release on request, your contracting support, your back office, and your training. A good FMO earns it. A bad one does not. What you should know going in. On Medicare, your street-level commission should match the CMS fair market value maximum for that contract year. If an FMO is paying you below street, ask why. On life, contract levels are negotiable based on production. New agents typically start at 60 to 80% of target. Producing agents move to 90, 100, 110, sometimes higher with volume. If you are producing and your contract isn't moving up, that is a conversation worth having. Reading your statement. Every carrier statement has a few common elements. Look for these every time a deposit hits. Member name or policy number. Effective date. Commission type. Marked initial or renewal. Period the commission covers. Gross commission. And any chargeback or adjustment lines. The 2 columns that matter most are the commission type and the chargeback line. Commission type tells you which year of the compensation cycle you are in for that client. The chargeback line tells you whether anything was clawed back and from which prior policy. If you can't reconcile a deposit, call the carrier. Most chargeback questions are easier to resolve in the first 30 days than 6 months later. Here's the action step. Open your last commission statement. Find 1 client. Identify whether the commission is initial or renewal, what year of the cycle they are in, and what the commission would have been at the CMS maximum. If they match, you are at street. If they don't, write down the gap. Do that for 10 clients across your top 3 carriers. By the end of the exercise, you'll have a 1-page picture of where every dollar is coming from, where you are at street, and where you are leaving money on the table. That document is the foundation of every commission conversation you'll have for the rest of your career.